Hi traders, thanks for joining me today on another video. I just wanted to cover off a topic that I posted about on Christmas Eve on the blog, which is called the emotional market sphere, separating yourself from the crowd. So I'll post a link to this blog post in the description box below. But I just wanted to expand on this and provide an example here today, and hopefully several examples as we move along in videos about how you can work this into your trading, so that we can see this happening in a concrete basis and not just looking at it from a theoretical point of view. So without further ado, let me get back to the chart and show you this example. So we have expectancy, which is based on risk to reward and win rate. So you have, I made a video about expectancy, but just to rehash briefly, you have win rate multiplied by the average win, and then you subtract the loss rate multiplied by the average loss. And if you do this in terms of proportion, risk to reward, so 1 to 1, 1 to 2, you'll end up with a number that represents a fraction of your average risk unit. So if E is equal to 0.2, then that means on average each trade you make 0.2 or 20% of your risk. So if you're risking $100 per trade, then over time blended, each trade you take returns $20. And so then it just becomes a case of sticking to your rules, increasing the number of markets you watch, and therefore the number of trades you take, and then you can leverage this number. So that's a little bit about expectancy. So it goes without saying that if you can increase the risk to reward whilst maintaining the win rate, then your expectancy goes up and you make more money. So how does this fit in with the idea of the emotional market sphere and what we want to learn about today? Let's say you get short here for whatever reason, and it doesn't, for now, the reason doesn't matter, and your stop goes here. Again, this is just arbitrary. Let's say you have a system, the entry is here, the stop's here. If you're targeting this low down here, and excuse the non-horizontal line, but you're looking at this range or this low down here. So you could exit anywhere within this zone, right? So if you're doing that, let's just put that back. Okay, so you could exit anywhere from here to down here. There are three groups of traders when they take this trade. There are organized traders who are bold. There are organized traders who are a little less aggressive. And then there are non-organized traders who are going to be the losers long term. And let me explain. You get short here, your stop goes there. If you get out here and you have a 50% win rate, then you're making money over time because this is a little bigger than this. So your stop is a little smaller than your reward here. So it might be 1.2, or I haven't measured it, but 1.1. If you're winning 50% of the time, you're making money, albeit not very much. But if you can do that consistently, that's great. If you're more aggressive, you're going to hold through this and you're going to target down here or down here. The lows of the range, a tick off the low, and then that extends your reward to here. So now you've got maybe 1.75, 1.5, whatever that is. Let's call it 1.75 to 1, which is obviously going to mean more money on a 50% win rate. So as I said, we have more aggressive, that's group A down here, and they have a 1.75 to 1 risk to reward, or reward to risk, with a 50% win rate. Then we have the less aggressive but still consistent, more conservative trader. He gets a I said 1.1 before, but maybe it's more like, let's call it 1.25. So he gets a 1.25 to 1. He gets a 1.75 to 1, he or she. And then you have the people who are winging it. And those people who are winging it are going to do something like this. Let's go back. We can't go back anymore, so we'll just cancel. Entry, stop. They're going to say, yeah, I know this is the zone we're looking for, but I'm not sure. I'm going to see what price does in this zone. And inevitably what happens is they realize they got to an area of profit taking here when they see the wick, and they try to hold on. And this wick here represents capitulation. And so obviously this person makes break even where they would have made a 1.25R trade, or potentially a 1.75R trade, and maybe they get out for a little more than break even, or they abandon the trade here on the break of this wick, and we're not close enough, but let's assume the body is around here, so they get out for a 0.5 to 1 reward to risk. And obviously as a 0.5 to 1 reward to risk ratio and a 50-50 hit rate is losing. So same trade, same setup, but the third group of people come out negative and the first two come out positive to varying degrees. So this is the area to look for here, down here, and then this is the key moment here. And a professional, if they miss this exit here, they'll simply wait for this to retrace, accept the possibility of loss on this one trade, knowing that the probabilities are in their favor for a retest, and get out some either down here or down here. So this video, it all seems obvious when spoken about like this, maybe or maybe not, dependent on your level of development. But the takeaway for this video is, don't just look at the market as an innocuous sort of non-threatening, well, it is non-threatening, but these waves are people reacting to things. So this is the reason why we see two waves into a level and then a sell-off, or one wave on a bigger time frame, a second wave, and then a rally, because people are getting out sooner than the level here, which is fine. They're adding wiggle room to their exit, or they're holding with conviction, and both are great. But what's not great is when you can't decide between the two and you end up getting out on the retrace with a trailing stop or an emotional capitulation exit here, because then you cut your risk to reward or your reward to risk down, and you ruin the expectancy of the method. So that's all I have for you today. If you enjoyed that, give it a thumbs up. If you're looking to get more videos like this, then hit that subscribe button. And as always, follow your plan and keep things simple. Back at it next time.